All right, welcome in. Happy Tuesday. This is the Cow Guy Close, and I'm Scott Shelley, also known as the Cow Guy. Thank you very much for tuning us in. We got another great show. We're having fun. Hopefully you are too. Lots to talk about too. Boy, it's all over the place. All right, how about this? Let's get started. Investors and traders alike are going to be gearing up for a pretty big week, stuffed with some potentially market-moving events, right? The Federal Reserve is due to hold its latest interest rate decision on Wednesday. That'd be tomorrow, along with other central banks around the world. We're not the only one. And then we'll have a data dump of corporate earnings, which will feature quarterly figures from big cap tech giants whose heavy spending on data centers has helped underpin the artificial intelligence boom, but continues to weigh on their stock prices now. Meanwhile, a fragile pause in fighting in the Middle East sends oil prices lower to begin the week trading. We were as low as 82 yesterday, and today we went below 80 into the 70s. The CME FedWatch tool, right? We watched that on this show. Still shows about a 35% chance of a rate hike this week. Are you kidding me? Yes. Polymarket puts it around 26. I think that that's nuts. But what do I know, right? I'd like to get my next guest's thoughts on all this stuff. It's a very busy week, so please welcome to the show Mr. Jeffrey Small, a partner in Retirement Income Source in Melbourne, Florida. Jeff, thanks for being on, brother. Really appreciate it.
Yes, sir.
I said a lot there. I'll let you pick and choose, but what are your thoughts?
Well, I think this week really is a stress test for the bull market. We've had a little bit of a pullback here. We had a peak recently, but investors need three things to line up: a Fed that doesn't become more hawkish, economic data that supports a soft landing, and earnings that justify, of course, today's valuation. So if we get all three, the rally might continue going into the fall. But if we see cracks in a couple of these, I wouldn't be surprised to see even more volatility pick up since we've had such a strong run, Scott.
Yeah, I mean, September can't get here soon enough, if you ask me, because I think a lot of this is part of the summer chop. We're going to talk about that in the next segment. But we do have Meta, Microsoft, Amazon, and Apple reporting tomorrow, two of them, and then Thursday, two of them. That'll be a big deal. But I want to say this to you. You know, we have a bond guy on, Laffer Tengler. His name's Byron Anderson. He was on last week, and he said, you know, the Fed does a lot of their own research, and they should. And one big research paper they've recently written is about raising rates into price spikes like we've seen with gas or with crude oil. And they say it's a really bad thing to do. But here we are contemplating it. And I don't think raising rates is going to help the price of oil. I don't think it's going to help your food at the grocery store. I don't think it's going to help anybody getting a mortgage, getting a loan, anybody with any revolving credit card debt. But here we are, with the market thinking we got a 35% chance we're going to hike rates this week. I say that's insane, but maybe you want to argue with me about that. I don't know. What are your thoughts?
I don't think that I think there's zero chance they're going to raise rates. I mean, Polymarket is Polymarket. But the economic data reflects there's a chance for that. When you've got the lowest unemployment filing since 1969, you could say the Fed's mandate is on top of their game right now. They're on it. But the rate decision is very important. But what's more important, Scott, is the chair's tone. What is Marsh's tone going to be? Is the Fed becoming more comfortable with inflation, or are they still worried about it reaccelerating? The market doesn't need a rate cut. It needs confidence the Fed won't become more restrictive. And that's really what we want to see going forward. And every new Fed chair gets tested. We know that. And the market is saying right now, we think there's going to be an increase because the economic data is too strong. 36% chance. I say zero chance. I think they're going to hold the line, and they're going to be less hawkish and more neutral at this stage of the game.
You know what? You just got yourself a ticket back. I'm gonna have you definitely back on. I love what you had to say there. We are in agreement on that. I think also, if you didn't ask, but I think the market's already kind of doing it for him, isn't it? I mean, with the 10-year yield up over 4.6, we hit 4.7 earlier. I mean, that's kind of restrictive. Those types of things that are happening in the market are, so they're already seeing that, number one. Number two is, I think if he does anything, Jeff, I think it's going to be with the balance sheet, not with actual rate moves. What say you?
Well, yeah, I mean, I think he's going to be data dependent as usual and maybe continue with the offload of the balance sheet or give us some new insight. But I really wish the Fed would break new ground. and get away from being such data driven and be maybe more consumer driven. Get away from the macro, focus on the micro. People need a break. Rates are too high right now for everybody, and eventually it will impact the economy. But hey, this could be the new norm because rates have to stay high, Scott, because nobody will buy our treasuries unless they are. And at the rate the government is spending, since we're never going to see a balanced budget in our lifetime, we might be permanently stuck in this rate structure.
Yeah, it's hard to argue with. You're right. And I think a lot of people really miss the fact that a lot of times the reason our debt is, our interest rates are higher than we would like is it because we have to give the people that want to buy our bonds a return on their investment, right? And so that's why you've seen that 30-year up over 5%, stubbornly so. The 10-year yield up over 4.6%, stubbornly so, because we need to be able to raise capital in the free market. And the only way we do that is we give a return that is higher than what most people would expect so that those people get a return on their money. And I think that's missed by a lot of the market. They just think that those rates should be able to come down, no big deal. But they can't come down if we can't balance our budget, can they?
They can't, but the market loves the government overspend. You know, spending 2 trillion, 3 trillion a year more than we collect in tax revenue. And so if we look at it more practically as pragmatists, Scott, we're going to spend 25%, and by the end of this year, 25% of all our tax revenue is going to go towards the interest on the debt. We have maxed out our debt to income ability to service it. There's going to be a fiscal calling at some point to where the Fed either has to do what the Bank of Japan did in the year of 2000 or the European Central Bank did in 2007 and be permanently stuck at zero and become their own financier. And when that happens, economies no longer grow.